Welcome back. In this video, we are going to look at activity ratios. Activity ratios are also known as asset utilization ratios or operating efficiency ratios. These ratios measure how well a company manages various activities, particularly how efficiently it manages various assets. These ratios are analyzed as indicators of ongoing operational performance, that is, how effectively assets are utilized by a company. As we said in the last lecture, efficiency of assets may have a direct impact on liquidity also, so some activity ratios are also useful in assessing liquidity. In this table here, I have shown some commonly used activity ratios. The table shows what item should be used in the numerator and what item should be used in denominator of each ratio. Activity ratios generally combine information from the income statement in the numerator and information from the balance sheet in the denominator. Income statement measures what happened during a period, whereas balance sheet shows condition at the end of the period. So to judge the performance during the period, it is important to take into account data both at the beginning of the period and end of the period, so that we don't end up giving importance to only the performance of the current period. Hence, it is common to use average balance sheet data using the end of the period values and the beginning of the period values instead of just using the end of the period value. So for example, in order to calculate inventory turnover, an income item cost of goods sold is used. This item essentially is cost of inventory that has been sold. In the denominator though, average inventory is used, which takes beginning of the year inventory value and end of the year inventory value and divides it by 2 to calculate the average. This ratio inventory turnover actually calculates how many times per year the average inventory is being sold. For example, if this year for a company the cost of goods sold is 120,000 while the average inventory is 10,000, the ratio is 120,000 divided by 10,000, which is just telling you that in a year the company is actually selling its average inventory 12 times, which also means it is able to clear its inventory once every month. This is represented in another way by calculating the days of inventory on hand. In short, this is known as DOH. This number is calculated by dividing the number of days in a year by the inventory turnover. So in this example, the DOH comes to 365 divided by 12 or 30.42, meaning that the company kept around 30 days of inventory on hand. Now let's discuss all the ratios one by one and their interpretation. We'll start again with the inventory turnover and DOH. Inventory turnover lies at the heart of operations for many entities. It indicates resources tied up in inventory and is a good indicator of inventory management effectiveness. A high inventory turnover implies that the inventory is held for shorter time. This means lower DOH. For any company, this number should be compared with its peers in the same industry to take a call on its effectiveness. A high ratio value relative to the industry might indicate a highly effective inventory management. Alternatively, it could also indicate that the company is not carrying adequate inventory, so inventory shortage might be potentially hurting its revenues. To assess which explanation is more likely, the analyst should compare the company's revenue growth with that of the industry. Slower growth combined with higher inventory turnover could indicate inadequate inventory levels. However, revenue growth at or above industry level might indicate that higher turnover is a result of greater inventory management efficiency. A low inventory turnover ratio relative to industry might be an indicator of slow moving inventory, maybe due to technological obsolescence or a change in fashion. In the next video, we'll look at some more activity ratios.